Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Dollar General. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. On today's Stock Play of the Day, we're going to talk about Dollar General. We had an inflationary report and we saw the stock market pop and we saw the bond yields drop. So the market is fairly strong today after a very weak market overall. We also have seen the NASDAQ, which has had 3 or 4 strong down days, finally rebound. I think it was a little bit of the trade the rumor, buy the news, the exact opposite of what a lot of people will do around a big inflationary report. We're at all-time highs as far as the inflation report consists of. And it's good to see the S&P 500 index actually battle back from some of the lows that we've had recently, but there's still a lot of chop in the marketplace. So I'm going to start by showing the S&P 500 index. We see here there's not a ton to talk about except for the fact that we just have a lot of chop. We have the 50-day moving average crossing over the 20-day moving average crossing over the 50-day moving average. And we see right around a lot of congestion right around that 200-day moving average. Now, the fact that it did not hold, that the last couple of days we actually broke below the 200-day moving average is not a good sign for the market in general. And then we have the VIX index hanging right around that 22% range. But the big news is really what's going on with treasuries. We have a 10-year auction today, or maybe it's a 2-year auction. I don't remember right offhand. But right now we see the TNX, which is the 10-year interest rate. I have the chart up here inside the VIX watch list that we usually focus on. And you see, we haven't seen this level of, as far as the interest rate is concerned, going all the way back to 2019. And we're kind of hanging right in that range. With the TNX, you move the decimal 1 point. So the yield is 2.7%. And that is probably the biggest concern of the marketplace, is the rate at which we are increasing the Fed funds rate. How many increases we'll have going into the end of the year. They're still talking about another 5 or maybe 6 increases, and a couple of them might be 50 basis points. So that has probably spooked the market the most right now, but we still obviously have geopolitical concerns, and obviously inflation is rocking and rolling in this economy. So where do we go when we're a little bit nervous about inflation? Well, Dollar General has always been a staple retailer that usually kind of benefits. They're in the lower end of the scale as far as cost wise. And we did actually see the marketplace reward Dollar General this week while the NASDAQ was getting beat up. All the mega caps really took it hard on the chin this week, and they're getting a little bit of a bounce today, but Google, Amazon, Facebook, even Apple, a lot of the stocks this week inside the NASDAQ were leading the markets lower. So the NASDAQ was the biggest drag on the marketplace. And we see a stock like Dollar General actually set an all-time high this week. So we're going to be basically trading that breakout to the upside, kind of an inflationary concern trade, but I'm going to be make it a speculative trade. We're going to look at what's called a long call spread. And let me show you that inside the options playbook, where we're going to go out about 14, 15 days, which on a speculative play based off of a breakout is my norm. I would normally go a little bit shorter term as opposed to longer term. We are getting into earnings season, but earnings in Dollar General is going to be we're going to avoid that. It's going to be out in May. So we're going to pick an expiration that does not contain the earnings, because we're doing this based off of what the chart is saying. Now we've gone recently on stock play of the day. We've gone back. We looked at a long call spread in Amazon. We looked at a long call spread in Google, and they were all based off of the stock split. So we picked expirations that contain that stock split, and hopefully we were going to get a strong move going into the actual split and beyond. So the expirations were the expirations were beyond the actual day that the stock splits. So that's why we went a little bit longer on our expirations. So let's go and look at the chart, and we're going to do a shorter term speculative trade in Dollar General based off of the fact that we just set a new high in that underlying stock. Now, I always have to say this in stock play of the day, this is not meant to be a recommendation. We're just trying to learn here. And what we're specifically doing is trying to take strategies inside the options playbook and apply them to the situations that are in the marketplace. So we always kind of look for underlyings where a long call spread might apply in this scenario, in this pricing arena. So if we look at Dollar General, and this is what I mentioned just the other day, broke out to a new 52-week high, a new all-time high, actually. We have all our ducks in a row, real strong move in Dollar General, all going all the way back to March. Basically, that's the one concern that we have, is that we're a little ways away from the 200-day moving average. But it's nice that we've had 3 or 4 days of a solid breakout above that 240 level. Came up and tested it, dropped precipitously, came back and tested it again, and now we have that breakout. So we're going to hope that that momentum continues. It's hard to be investing in the marketplace overall when we have so much chop in the marketplace. So that's the general marketplace makes it a little bit scary to be doing swing trades, which that's what I would call this trade. But that's what the stock play of the day is all about. So we're going to manage our risk, and we're going to make this basically, we're going to have approximately a 50-50 chance. We're going to risk as much on the downside as we can make on the upside. And so how do we do that? We have to manage our time premium. But you see right here, quite simply, we had a breakout. That's why we're going to look at this long call spread. I'm going to run to the Ally Invest option chains. And I'm going to also let you know, get your questions ready to fire them at me inside the chat box. This is a very interactive webinar that we do every Tuesday, stock play of the day. And we want you to ask any questions that you may have. I'd love to try to address them. Put them in the chat box, and at the end of the show, we'll try to address them. All right, so wanted to highlight a couple of things here. Let's get rid of that trade right now. We have the earnings date. 5/26 is the anticipated earnings date right now. And I always like to check that out. So we're in the middle of earnings season. You're going to trade any options. You want to make sure that you look and know when that date is, because it is obviously a big deal. It affects the prices of the option contracts. And I always confirm that if I go out and I look at the May 20th date, which does not contain earnings, we see that the implied volatility of the 250, we'll just look at the 250 strike call option, is trading at about 23% implied. There's the IV column. And if we go to the 250 strike on the May 27th, which would contain earnings, we're seeing it trading at around 27% implied volatility. So we definitely got a skewing of vol, or a tilt, between the two expirations. And so that implies to me that, yeah, the marketplace does assume that this is when that earnings announcement's going to be. We're going to avoid it. We're going to go out about 17 days here. We're going to go out about 17 days on this scenario, and we're looking at the April 29th expiration. We're going to go a little bit in the money. And I'm going to pay attention to what the value of the put is. This is the put side of the trade, just to try to see how much time premium I am buying. I do not want a lot of exposure to time premium. I'm going to try to set up my spread so that I'm trading mainly the stock price movement and not dealing with some of the issues of option pricing. And one of the biggest issues is, if you're buying options and you're paying time premium, you have time decay. So we're going to buy one option contract that is a little bit in the money, has more intrinsic value than time value. And then we're going to sell an option contract that's out of the money, that's all time value. So we're going to be buying approximately, if I look at the midpoint, right around $3.80. It's not an exact science by looking at the put, but we don't need it to be an exact science. We need to kind of know the amount of time value that we're buying. On the opposite here, we got the 250 strike call option. And on this call option, we're selling, let's call it about $3.10 worth of time value. So we are paying more than we are buying, but I like the way the risk reward ratio plays out here. So we do got a little bit of susceptibility to time decay, but obviously if we just bought the option outright, we would have a lot of susceptibility to time decay. So if I scroll down, here's the workbench. We are buying the 242.50 call on that April 29th expiration, and we're selling the 250 call. We're 7.5 points wide. We're going to pay, let's call it 380 to make the math simple, right? The midpoint's at 378. You never guarantee a midpoint fill, but that's where you want to try to work this trade. And if we do that, that means that we're paying 380 and the maximum that this could trade for is 750. So our upside is 370. And that's where the 50-50 comes in. We're paying, we have about as much risk on the downside as we have potential gain on the upside. And you manage that. The way that you can get that type of situation is managing your time premium that you're buying versus what you're selling. So we have a 50-50 trade in. We're managing our risk on the downside, and we're trying to give ourselves more appreciation to the upside. We're only going out for 14 days. We're hoping that that stock can get make a little bit of a jump up to the 250 level. This is definitely a speculative play, and we're hoping that the momentum of the breakout to a new high on the upside and the inflationary news that we received today may drive Dollar General higher. So we're going to make this the official paper trade. Click on the trade button here, put this in the right rail. And here it is for this week. Buying to open one of the April 29th expiration, 242.50 calls. Selling to open one of the April 29th, 250 calls. Doing this, we're going to say a net debit of 380. So I'm going to click on that bid. It looks like it's moved a little bit. I'm going to put $3.80 in. That means for every 1-by-1 spread that we're doing, we're going to pay $380 plus commission to establish that trade. And on the upside, the maximum it could trade for is 750 minus the 380. That means that our max upside is $3.70. Now, the reason why we go a little bit shorter term is kind of highlighted in our profit and loss graph. Let me remove the trade ticket on the right rail. And you see that when you have an expensive underlying stock, like I would call Dollar General an expensive underlying stock, here is the actual price of the stock. But to start with, on long call spreads, they don't max out until you get a little closer to expiration. The colored line is our graph as of right now, and that's a theoretical what if scenario, if you will, with 17 days remaining to expiration. As we get closer and closer to the expiration date, the dotted line is going to come into play, and we can adjust that in our profit and loss calculator by adjusting the days to expiration. So I'm going to fast forward quickly here. We'll go down to like 2 days remaining to expiration, and it will regraph itself. And now you see the colored line morphing into the dotted line. And at expiration, then they obviously would be right on top of each other. So if I'm doing long call spreads, I need to be very cognizant of my timing. Obviously, if you go out further in time, it gives the stock more time to move. But if you are correct on your forecast and you're correct early, it's hard to make the maximum of that trade. So you want to give yourself enough time for the trade to play out, but you also don't want to go out so far in time that you don't get rewarded as much as you may expect to be rewarded for having a correct forecast. And our forecast is obviously that the stock would go up to somewhere around that 250 range. Now, if we go down and let's go to 1 day remaining expiration, it'll move just a little bit here. One other thing that can happen is that if you are correct on your forecast, and the deeper these option contracts both get in the money, the time premium comes out too. So that's another scenario that if you do get a real strong move to the upside, eventually time premium will go away. And that's what you need on your short option contract. It'll become more intrinsic value, less time value. And you can also achieve the maximum by being more in the money, way up above that 250 strike on your short option contract. All right, so if I look at this long call spread and I'm putting it on, how do we want to manage our risk? Now, we managed our risk by setting it up and making it basically a 50-50 trade. We're paying 380, and the most that we can make is 370. So our risk is already capped as opposed to just buying the option outright. Now, some people, if we're going to pay 380 for it, will try to adjust the risk on the downside. They may say, well, if I'm down $2 on the trade or approximately half of the value, I'm going to get out, but I'm going to let my winner run on the upside. So if you want to do that with your trade, if that's how you want to set it up, when you're doing your speculative long call spreads, you want to stay consistent. And hopefully, if you're watching the marketplace and the market did come down on your long call spread, and eventually it's trading for $2, 180, well, at that point in time, might want to close it and get out. Now, on a lot of these shorter term ones, an alternative trade is to roll it into a butterfly. And if the market does go against us, we'll come back on this Friday's show on the stock play of the day overtime, and we'll talk about that adjustment. It's one of my favorite adjustments to do to a long call spread, is to just basically roll it into a butterfly. So with that said, if you have any questions, please put them in the chat box, and I will be able to address them shortly. And we will look at, when I'm doing this long call spread, where exactly on the downside do I want to get out of the trade? So if I put this trade in and I'm comfortable with the trade to start with, first thing that I'm going to do is try to capture as much as I can on the upside. We know the maximum I could trade for is 750. So once I have my long call spread in, let's say that it executed, I would go in and put in a good till canceled order to close out that position. I'm going to sell to close the option contract that we bought. I'm going to buy to close the option contract that we sold. Now we're looking at a net credit to the account. We know the maximum is about $7, $7.50, I'm sorry. So I'm going to look at right around $7. Now, getting that last 50 cents out of a long call spread is really hard to do. It's hard to extract that last 50 cents or 20 cents or 30 cents out. So here's the order that I would put in. If I did execute the trade, I would come right back in, put this order into close, and I'd let this work for me just in case I fall asleep and I'm not watching the market. And hopefully I can get out at that type of profit on the upside. On the downside, you decide. Do you want to let it run? Or are you going to get out if you're down about 50% on that trade? So if you have any questions, type them in the chat box right now, and I don't see a lot of them here. So with that said, I guess that's going to be it for this edition of the Stock Play of the Day. We'll be back on Friday, and we'll do a live show, Stock Play of the Day overtime. Please let people know about our event. If you click subscribe, you ring the bell, you'll get all the alerts. And share this with your friends and family. Let them know about the Stock Play of the Day. Thanks for coming, everyone. We'll see you this Friday.